recording.
Morning in progress.
Good morning, everybody. We're going to give it just a second for people to come in. Hey, Jennifer. Okay, we're going to get started. Welcome, everybody, to the Insurance Hot Topics. We're excited to have you guys with us today. Karen, could you advance the slide for me, the next one? Just wanted to take a moment to thank our 2025 Diamond sponsors. I always like to acknowledge them. They're fantastic. We actually have two of them on here with us right now today. We have Jim and Karen. So thank you guys for your leadership and continuing to be our Diamond sponsors. We appreciate you. Next, I'm going to give Diane White a chance to speak from Alliance Association Bank. Thanks, Diane, for sponsoring today.
Thank you very much. Thank everyone for attending this amazing webinar. This is definitely a hot topic. And Kathy, I want to thank you for the opportunity of being a sponsor today. We are really thrilled to be in a situation where we can demonstrate our continued support. I am Diane White. I am the Midwest region for Alliance Association Bank. My territories consist of Illinois, Michigan, Minnesota, and St. Louis, Missouri, as well as Wisconsin. Alliance Association Bank is a leader in the community association banking industry, providing advanced technology, deposits, lending solutions to those we serve. We partner with most software platforms. We've been in business for 16 years with consistent leadership, culture, and leadership. Roughly 110 employees solely dedicated to Alliance Association Bank, over $9 billion in HOA deposits, servicing over 1,200 management companies. Our key support for the management companies consists of dedicated one-on-one customer service, fee-free banking, meaning no lockbox analysis fees, no bank account fees, no fee for Positive Pay. Positive Pay is a fraud protection platform, so we offer no fees for that, particularly during these times where fraud is prevalent. We want to make sure that we're supporting our management companies and associations appropriately. Additionally, we do not charge any fees for stop payments. We partner with most software providers to create efficiencies for accounting teams. Lockbox, we own our own lockbox. Our facility is in Chandler, Arizona. We also have a convenient location in Carroll Stream, Illinois, Orlando, Florida, as well as Las Vegas, Nevada. At Alliance Association Bank, we provide our services to our management companies. We want to make sure that we're providing excellent service for the management companies so that they can provide assistance and support to their clients. When working with us, you'll find more than just a bank. We're a true business partner at Alliance Association Bank. We're dedicated to you, your success, and business growth. For additional information, please go on our website and feel free to get additional information regarding our listing in the directory at the CAI Heartland chapter. Thank you, Kathy.
Thanks, Diane. Next up, I want to also thank Daniel and Henry Company, Jim Rickson, one of our board members. Also, thanks for sponsoring today, Jim.
Thanks, everyone, and thank you to all the attendees. The insurance world has been probably top of many of your minds for the last few years. It's been a rough ride, going on about 3 years now. And, it's important to partner with a insurance broker, insurance agent that is dedicated to this industry because it is changing by the day. And so the Daniel and Henry Company, we've been around since 1921. The first known community association type policy we wrote was in the 1950s for a community in the Central West End, and we've had community association clients ever since then. We also know that managers and trustees need a lot more information these days about the state of the insurance market, about all these rules that, some of the things Craig from Philadelphia is going to talk to you about, loss control. So I want to highlight our website. It is condoinsure.com, and I'm going to drop it in the chat. In particular, if you go to condoinsure.com and click on the resources tab, there are resources for all different types of community associations, whether you're HOA, villa, resort community, or condo association. So please go there. You'll find a lot of information. We update it very regularly, as well as our blog. And so if you have any questions about the market, about barbecue grills, fireplaces, aluminum wiring, and all the things we get to deal with every day now, it's all there. So thank you again for attending. Hopefully you get a lot out of this. We've got some great speakers lined up here.
Thanks, Jim. Next up is Karen O'Connor.
Hello, everybody. Thanks for attending today. I'm with O'Connor Insurance, and this year we are celebrating 50 years in business. With a niche in insuring community associations since the 1980s. We've had all these years of crafting the coordination between master policies and unit owner insurance, clearly separating the association's responsibilities and laying out the unit owner's responsibilities. And we've started this before there was such a thing as community association lawyers or community association insurance professionals. But here we are today with our wonderful community association team at O'Connor Insurance, with many of them with CAI designations of community association and risk management specialist, CIRMs. So thank you to all the communities we've served. And I'll leave it there, Kathy.
Karen. Awesome. Thanks, Karen. I also wanted to acknowledge that Karen is also our program coordinator for the day. So Karen is going to be introducing our fantastic presenters today. So thank you, Karen, for doing that. I'm going to step away for a minute and make sure everyone got in, but thank you.
Okay, so here we are with Craig Simpkins in the blue shirt here. He is Senior Risk Consultant, Philadelphia Insurance Company. Craig has over 25 years of risk management experience with national insurance companies with an emphasis on property insurance. Craig is with Philadelphia Insurance Company, where his responsibilities include risk management, training, and delivering value-added services to help reduce exposures and loss. Craig is well experienced in multifamily properties, which many of you might have seen him on your site at your communities. Next, we have Maddie Beja, Area Vice President, Risk Management Services, some know as RPS, out of Chicago. Maddie's been with RPS for almost 10 years, working alongside Kristen Nadler. She specializes in providing commercial property coverages for large, complex, and hard-to-place properties. Our master policies at RPS have become part of the hard-to-place category. Therefore, she is well-versed in community association coverage. And last but not least, we have Dawn Bauman. She's not quite logged on with us yet. She is from CAI headquarters. She is the Chief Strategy Officer for Community Association Institute headquarters. Dawn has worked for CAI for more than 20 years at the international and chapter level. Dawn is a leading expert in community association housing model and is frequently sourced in the US and international media outlets, including the Wall Street Journal, US News and World Report, New York Times, and more. Dawn is a regular speaker and educated worldwide, and we are very fortunate to have her. And with that, we should get started with Craig.
There we go. Get my mute off. I want to thank everyone for having letting me participate today and share just a little bit of information with you this morning. As Karen indicated, I've been doing doing risk management and insurance for just under 30 years. A lot, we handling a lot of different exposures, but a major exposure is going to be working with condominium associations. So my portion of the presentation, just want to really share with you some different risks that are out there that really that underwriting is looking at um, uh, thoroughly, but it's more importantly that, you know, these are areas that we see losses, that we see claims that come through. And it's so if we can kind of talk through those and reduce the potential for you to have to go through that, that's exactly what that's what I do as a risk management consultant, is help to identify and address those exposures. So homeowners associations, condo associations, you know, these are like a business. You know, and all of them comes with different risks. You know, so we'll kind of talk through some of the, you know, what I would say some of the major risks are, and some different things that you all can do to help reduce your exposures to those. So with that, let's go to the next slide. So first off, a good preventative maintenance program is critical. You know, an ounce of prevention is worth its weight in gold. You know, that is so true. You know, when you look at um, risk management, you know, general liability, the leading loss driver in general liability is slips, trips, and falls. So, you know, starting off with walking surfaces, making sure that, you know, that we have good walking surfaces, that there's good uh, lighting in those areas for those walking surfaces, looking at your drives and seeing if there's any potholes. If there are, getting those taken care of. If for sidewalks, you know, if you know, whenever you start seeing, you know, often tree roots and things like that causes the sidewalks start to buckle. You know, once it gets past that half inch or so, it's good to grind those down, smooth those out. That one thing is, you know, our litigious society that we're in today, people are looking for different opportunities. And if you have a pothole, or if you have a raised lip, or if you have, you know, those are things that people take, you know, they're like, oh, okay, I slipped, I tripped and fell. And now, you know, you're at liability because, you know, that exposure was there, and it was obvious. And, you know, we try to, you know, push some back on them that, you know, that's something they should see. But, you know, there's, again, it gets into that maintenance factor that comes into play. And so just making sure that regular inspections are being done. You know, I always recommend, you know, if you have, you know, maintenance person on site, you know, having them, you know, walking the premises daily, looking for some of those different things. The parking stops are another, you know, that, you know, highlighting those. If you have a concrete or an asphalt um, uh, you know, drive, you know, making sure that you're coloring that with, you know, like a bright yellow or something that will make that pop so that people will see it. Those you'd be amazed how many people are tripping and falling on those. Leaves, I mean, they, as soon as they get wet, they're slick. You know, now it's like people are walking on ice, and you get somebody that trips and falls because we're not adequately, you know, clearing off the sidewalks and lots. And then those gumballs that you have, that those trees, you know, that when somebody steps on one of those, you know, they're going. And so making sure that you're looking for those type of things to kind of reduce those exposures. Another would be the condition of your roof. You know, having inspection, you know, roofing contractors, you know, they're not going to charge you. A good roofer is not going to charge you to come out and do, you know, an inspection of your roofs. You know, they're looking for your business. They want to, okay, if you're going to call me out to do the inspection, they're going to give you uh, an honest review, because you can also have another person come out if they and get a second opinion if they say that something needs to be done. But you know, you want to make sure that you are having your roofs looked at. You know, leading loss driver from property is water intrusion. A lot of times water intrusion can be prevented by just having, you know, a good roofing structure that's solid and in play. You know, with, you know, you're looking for worn roofs, whether it be, you know, the shingles, if you're a shingled roof, are there any that are missing, are they buckled? You know, you can kind of look up at a roof and see Yep, I can speak a little louder. You can see if a roof is struggling. And then also just know that we have a lot more storms that are hitting these days, with that include hail, that include, stronger winds. So these roofs that we're finding them not lasting as long as they were initially thinking that they would last. So again, having a good contractor look at those is important. If you have a flat roof, getting up and getting on it, taking a look at those roofs. If there's water ponding on a flat roof, that sun that just comes down, it's just beating on that roof. That just deteriorates that material so much quicker. So and then, clogged drains is another big one, whether it's a flat roof or a pitched roof. If you have a clogged drain, that's going to, shoot up over the top of the gutters. And, then it tends to get up underneath the fascia, and you start getting water intrusion inside your building that you don't even know about until all of a sudden you're seeing, the water spots on your roof, on your ceilings. So again, those are quick, easy ways to help reduce some of those potentials. There are some other things that I whether it's units that are stacked or you're side by side, that really should be aware of, is just different water monitors that they're out there. I mean, there are some that like FlowLogic, that does automatic water shutoffs, where if your water is running past what is kind of that what's normal, it can shut off the water for you. There's also a lot of different sensors that are out there. Many of them are web-based and app-based, but it'll put an audible alarm if water is detected. A lot of times there's sensors on the bottom of the devices that if water touches that device, it will, alarm and let you know, or even send you a text or so saying water's been detected. I know at Philly, we provide these, for our policyholders, and it also includes temperatures, to help prevent the freeze claims from occurring. So there are lots of different solutions that are out there for identifying water issues, and they're definitely worth doing. And I recommend definitely putting them in, if you have areas where, say, you have a sprinkler system in your condominium buildings, and so wherever that sprinkler riser is, a lot of times you're not going in that riser room. You may have a heater in there that's supposed to kick on, but if you're not going in there and the heater goes out, you're not going to know. Well, if you have these sensors in there, they're going to alarm you and let you know that something's going awry before it turns into a major loss. So that's it's important to make sure that, again, from an heating and air conditioning standpoint, that we're looking at the boilers, we're having boilers inspected, that you're looking at the hot water heaters and furnaces. If they're gas, keeping distance away from those. National fire codes, they call for a 36-inch clearance between your gas water heaters, boilers, furnaces from combustible storage. So it's good just to kind of keep those. A quick little way that I always recommend for my insurers to do it is to put tape on the ground and kind of hash it out. That's the universal sign for don't store here. If somebody stores, they know they're doing something wrong. So, but that'll help prevent some of those from happening. You can also do that around your electric, because electric, they're supposed to, again, National Fire Codes and National Electric Code has a 36-inch clearance around electric panel. Goes off. Even with your panels closed, you still have arcing that comes in and out of your electric panels, and they have been known to start fires. So for those buildings that do have fire sprinkler systems, making sure that they are being inspected at least on an annual basis by a qualified sprinkler contractor. They'll also do a 5-year where they actually send us a camera up inside the pipes, make sure that there's no corrosion, things like that, so that the system will work as designed. From a landscaping standpoint, looking at the trees, making sure that they're in good condition, especially those that are close proximity to, the homes and buildings that, if they're struggling, that, you can have an arborist, or you can just have somebody come remove those trees. As they start to grow, a lot of times we plant trees, but we don't realize how big they're going to get. Next thing you know, they're growing in, right, and hitting up next into the building. That also allows squirrels and other raccoons and animals to be able to gain access to your roof and to your building, and get into attics, and that creates all sorts of havoc for you. So I always recommend making sure that trees are pruned back at least 3 feet from structures. That way they don't get blown up against the homes. And then just from a lighting and security standpoint, making sure there's adequate lighting around. That's both good for security as well as for making sure that people can see where they're walking, to prevent that slip, trips, and falls. Okay, let's jump in. Let's go to the next. So I want to talk about a couple different types of electrical issues that have really been major issues in the condominium arena. Aluminum wiring. From 1965 to 75, they started trying to use aluminum wiring instead of copper wiring. Copper was more expensive at that time. So what they found was, it was a complete disaster. There were a lot of fires that were starting from it. The copper and aluminum, they expand and contract at different times. So if you're putting, a copper wire and an aluminum wire and putting them in a wire nut, if they contract at different times, one starts to pull out. Now you start have arcing inside your walls, and it started, causing fires. The aluminum was also a lot more brittle. So so then we were having wires that were breaking. So there was it's really proven to be, it was the wrong move to be able to make. So with that, there's 3 different types of really remedies to that I would recommend. First would be, again, pull the wire out and use copper wire. A lot of times that's pretty costly, so people don't do that as much. There's a copala method. That one, it actually does a shrink wrap around the actual connections, and that one has to be done by a licensed, and actually both of these need to be done, by licensed electricians. But the copala they have to be approved, for that method. Aluminacon, that's the one I have on here. That one's a little bit more reasonably priced, but each wire that goes in there is put into its own little area, so doesn't have a chance for it to contract at a different rate. Those they take up a little more space inside the boxes, but they work well. Some people have tried to use the Ideal 65 wire nuts. They're like the purple wire nuts, and they have kind of a solution inside them. Those have not been approved by the Consumer Product Safety Commission. Those are not something that we approve, and most insurance companies would not approve, just because, if that fluid drains out, now you're running into the same issues as if you had a regular wire nut. Okay, let's go to the next one. Okay, so there are several, again, we had this era of aluminum versus copper, and Federal Pacific was a company that was around that provided electrical boxes and circuit breakers. They used an insufficient bus bar that would cause it allowed the circuits to fuse to those bus bars. So even if they popped, they would still be running hot. So we were seeing a lot of electricians, we're seeing electrocutions, as well as fires that were starting because, if the circuits were popping, they were still running hot, and it wasn't stopping the current from going through those. Federal Pacific is no longer around. There's a couple others, Zenco and Square D, their QO electric panels. Those were all, again, with a similar type of scenario where they had insufficient materials that they were utilizing, were causing the electrocutions and fires. They're easy to identify. On the outside of the box, the panel box, it'll say FPE, for Federal Pacific Electric, or if you open it up, you can look in there. I put an example of what it looks like here, because if they have on the toggles on the end of them, if they're red, that's kind of the telltale that's going to be a stab lock breaker for Federal Pacific. And not all Federal Pacific breakers are going to be bad, but the stab locks are. And it says, again, on that top verbiage on that box shows, it says stab lock, but the stab locks are really identified by those red ends on the toggles. So that's kind of the easy way to be able to tell that. But if you have a Federal Pacific breakers in the homes and buildings, to make sure that you're getting those removed. Get a licensed contract electrician to come out. They'll remove that. They'll put a new panel and breakers in that are up to the current codes, and will reduce those fire potentials. Zenco, that's another one, and the Square D. Both of them, what they do is they have kind of colored, the whole toggles are colored. So again, in that picture there, I know it's kind of small, but they'll have red and green and yellow and different colored toggles. So if you start opening a panel and you see different toggles in there, then that causes you to pay attention and look and say, okay, yep, this is one that we're not wanting to probably be having in our buildings. Again, these were done in those 60s to 70s time frame. I would say anything 80 and after, you're not gonna, if that was built, you're not gonna see the Federal Pacific or the Zenco, but it was Zenco Sylvania, and GTE Sylvania. Though they kind of, when Federal Pacific went under, they kind of picked up some of that materials and such, and started utilizing before they realized, okay, this is why they went out of business. So those are the ones that you want to look for. With Zenco, a lot of times it's Magnetrip is embossed on the outside of the panel. But again, when you open up the panel, if you look and you see colored toggles, that's probably what those are. And those are not things that you're going to want to have in your buildings, because they're notorious for starting fires. So next one, from a plumbing standpoint, the polybutylene piping, those were made of an insufficient piping material, plastic material. They degrade over time. Those have well known for resulting in leaks and pipe bursts. So having plumbers come and take a look and see if you have any of those, they'll probably replace those with either a PEX piping or a copper piping. But you want to get to those before you do have the pipe burst and the leaks that occur, because again, once you have that, that's when it creates a large loss that you're dealing with, as well as that knocks you out of the home for extended period while it's getting fixed. So those were most commonly built in the homes that are built from the 1970s to the 1990s. So that one went a little bit farther into the time frame, newer time frames, but definitely something to address. You probably all heard about asbestos. Asbestos, it does not it won't degrade. So, once somebody gets that in their lungs, they have that in their lungs. There's nothing that they can do about that. And it causes silicosis and things, but it creates some, major health issues. So, it's good to know if you have that in there. There's different ways that you can, address asbestos in buildings. It needs to be identified. That's the first thing. But then, you can either encapsulate it or remove it. So you want to have a professional that's going to come and look for that. A lot of times asbestos is going to be the pipe wrap that goes onto plumbing. So if you have old plumbing and if you have an older building, you'll want to see if that's, just insulation, or if we have asbestos that's doing that. If the asbestos wrap is ripped and things like that, then it becomes airborne. That's when it becomes harmful for anyone that's in that area. So it's important that if you do have asbestos, that you do have, signage up indicating that there's asbestos in an area. As I indicated, you can remove it or you can encapsulate it. Encapsulation is taking that is basically putting some sort of covering on top of that, and then making sure that it's not ripped and open to where it's going to cause issues. Some asbestos was also in adhesives and things like that. So some of those smaller tiles, those ones that are the kind of the 5x5s, the 8x8s, those a lot of times have asbestos sealant on it. As long as it's that you're not having any tiles coming up, you're still going to be okay with those, but they need to be identified. And then you need to have some sort of, that they need to be monitoring that, making sure that there's no issues for that to get airborne for somebody. And then, a lot of times, you'll also want to just have a book that shows this is where asbestos is at, this is what we've done. And that shows if your abatement program that you're going to have to get those removed, or whether you're just doing the encapsulation and monitoring it. Let's go to the next one. Lead paint is another for some of the older buildings that we've had. Again, there's a couple different ways to handle lead paint, just like there's we did the encapsulation or removal that with asbestos. You have that similar with your lead paint. You can encapsulate it by putting a special coating that can be purchased, and basically you're painting it over it to make sure that it's and it's a watertight, airtight barrier that's going to go on top of it, just to make sure that somebody's not getting access to that lead-based paint. You could also do barriers, such as like building a wall, and whether it's framing out and drywalling and putting that behind the wall, that works as well. Or putting some sort of aluminum cladding or something to cover it up. So that would be your enclosure. And then removal would be if you're going to scrape and strip and you kind of blast off any of that paint, and then put new on. With that, you're making sure that that it's all sealed off when they're doing it, and that they're using the protective equipment to keep them from, again, breathing that in. And then replacement would be for your windows. Your lead paint's going to be what's going to be on the frames around the window sills. So some of those have those. So it would be to just remove those windows and replace those with new ones. You can also do the coating on top of that as well. But the best route for that is going to be kind of that replacement or removal. Okay, let's get into amenities. So I start with the amenities. I start off with our fitness centers. It's so important with the placement of the equipment that you're putting into your fitness centers. Each one, you're wanting to make sure that there's adequate space between one and the other. Somebody's getting off, that they have access to get off before hitting someone next to them. There are specific guidelines with different measurements that should be, but as long as you're keeping a decent a couple feet between, you should be fine. The one that I see that's the worst is with your treadmills. A lot of times people try to face those so people can see out and see who's in there and that sort of thing. So they kind of butt them up next to a wall. You really need to have 3 feet between the end of a treadmill and and whether it be a wall or another piece of equipment, because what you don't want is somebody to get thrown off that treadmill and then to fall back on that treadmill, because there's they all have them to where it'll shut off if it gets pulled away, but no one ever uses them. But if somebody gets pushed, falls back on that, it only takes about 10-15 seconds for that individual to have burns down to their bone from the treadmill. So I've seen it, it's horrible. So making sure, at least 3 feet behind treadmills is good. Routine inspections on the equipment, making sure that they're in good working order, making sure that you establish rules, who can be in this, setting some guidelines on ages of having a minimum age that you're allowing, somebody to be in there without a parent, or a minimum age that they can even be in the fitness room. Making sure that we have cleaning materials, especially, during these winter months when you have the flu, you have COVID, you have things, you want to make sure that people are wiping that off. And then, an important thing is, having each condo or homeowner, sign a waiver of liability. And I recommend having, a lawyer, just having a lawyer for all your amenities, provide you some verbiage for a waiver of liability. Again, each jurisdiction's a little bit different with what they can be, so that's why I always recommend just having a lawyer say, hey, I just need a waiver of liability for my amenities. Can you give me something? And then specify this one's for fitness, this one's for aquatics, this one's for, so that way, they've kind of, you've been able to protect yourself somewhat from, if they are, not following, the, proper procedures. Let's go to the next one, pool safety. Okay, this is something that, we want to make sure that, there is proper fencing around, to secure any pool. If it's an outside pool, we want good lighting as well. A lot of times, you'll get people that'll, if there isn't good lighting, then they're jumping the fence. So we want to make sure that, that we secured that, making sure that if the gates that they will, that, the hinges on them are good and they're gonna shut fully. Making sure that we have life-saving equipment, whether it be the hooks and the ring, things like that, to make sure that they can get in there. Good lighting allows people to be able to see inside the water. So that way, if somebody is drowning and things, you can see them. It's important to have visible depth markings, especially for those pools that have deep ends, to make sure that they know where it's going to start to get deep, and that allows parents and individuals to know where, if somebody can't swim very well, how far they can go. It's good to have rules posted as far as specifying hours, who can be in there, supervision. Those are important to make sure that we have. If there's no lifeguard, making sure that it's a swim at that's posted all over. Just swim at your own risk. That no lifeguards are here. If you do have lifeguards, making sure that you're identifying the hours and that the lifeguards will be there. And it's getting into horseplay, getting into whether they're allowed to have alcohol and glassware and things like that. That should all be posted on your rules. Slides, diving boards, they're a lot of fun, but not recommended. That's where horseplay occurs. That's where we see a lot of injuries. So we definitely discourage any diving boards and lifeguard and diving boards and slides. Playground safety, that we need to make sure there's good, spacing around the equipment that's there. The biggest thing with playgrounds, I would say, would be preventive maintenance, and then also the making sure that we have adequate protective surfaces underneath it, whether it be the rubber foam materials, or if you're talking, pea gravel or mulch, or the rubber mulch. We're seeing more and more concussions starting from playgrounds, and so that's why it's so important to make sure that you have that. And a good little trick for that is, once you get the right amount of cushion, if you put a piece of tape or a piece or paint on the structure, that this is the height it's supposed to be. That gives you a quick visual of when you start seeing that go down, that it's either compacting or getting eroded away, or that we need to get more in there to make sure that that's in there. Routine inspections, just making sure that, again, that the play structure is in good condition, that the slide doesn't have any holes in them, that they're securely fastened, just making sure that, the railings are secured for structures, elevated structures. And then again, this is something that you want to have, each homeowner or condo owner, sign a waiver, just, again, that they're responsible for, they're setting themselves on these and their guests on that, that playground. Okay. Talk a little bit about, waivers and such. Risk transfers it's does a tremendous amount for somebody. It doesn't cost you anything. But any type of vendor that you have coming doing work on your property, you should be getting certificates of insurance from them, which shows proof of workers' compensation insurance and general liability insurance for those contractors. Limits, they should typically be equal to your policy limits. You can, a lot of times with condo owners, I recommend, having kind of to where you guys get, okay, these are our approved vendors. You can choose from these approved vendors to get work done. And then having somebody make sure that you have adequate, that those vendors have adequate insurance, that you have their certificates on file, and that they're naming you all as your association as an additional insured on their policy. That's important because if there's any changes in the terms and conditions of their insurance, you'll be notified. And then, having some indemnification language written into the contracts. Indemnification language is going to be just where they're going to, hold you harmless due to negligence on their behalf. That's kind of some of the types of language that you want to see in there. And then finally would be the, from a fiduciary standpoint, making sure that you're establishing proper funding, for those improvements, capital improvements that are going to be made, whether it's being, your drives, your sidewalks, your roofs, it's what, those are expensive, to repair. So you want to make sure that you're budgeting that and making sure that you have that in there. And then the other part would be just safeguarding your reserve and working bank accounts, making sure that you have, it's not one person that's responsible, but you have multiple people that are holding each other accountable. That way you can make sure that no one's taking advantage of the money that's in those accounts. So kind of in summary, good preventive maintenance program, that's key. So making sure that you have regular inspections of the premises, whether it's somebody that's an employee or whether you're having a contractor come do it or a property manager do it, but making sure that those are being done on a regular basis, looking for that. And I'm a firm believer in using checklists, because the longer you're at a place, the more you start to look over things, and you start to miss those things that. But if you have a checklist, then that puts that back in your mindset to make sure that you're looking for, making sure that ensuring your building updates are being completed. Again, if it's much cheaper to get something repaired than to have to get it repaired after you having a major loss. So qualified contractors, whether that's your roof, electric, plumbing, HVAC. Whether it's lawn care, snow and ice removal. Those are some of the big hitters that you want to make sure that you have good risk transfer on. Good controls on your amenities, good lighting and security. We just talked about the risk transfer and practices, and then good fiduciary controls to reduce potential for theft in that arena. So that's all I have. Thanks for your time.
All right. Well, hello, everybody. My name is Maddie BJ, and I work at Risk Placement Services, which is a wholesale broker out of Chicago, Illinois. I just want to thank you all very much for the opportunity to come and speak with you today. I think that we've got a lot of great content and hopefully will be really informative for everyone today. So, just kind of starting out, kind of just introduce myself. I, as was mentioned earlier, have been at RPS for about 10 years now, focusing just strictly in property insurance. So that's, going to be a lot of, to your middle market to larger shared and layered programs. And specifically, in the Midwest, I would say exposure. So we see a lot of, condominiums and have been helping find solutions for those, kind of as the market has continued to change. So, going through what the presentation will cover. So, what is excess and surplus lines? The benefits and concerns with E&S. And then, how do we, as all of you, stay out of or get out of E&S insurance? And then lastly, rounding up with just an update on the market. So, kicking things off, I'd like to go over, what is excess and surplus lines? I think you'll hear, and you'll probably hear, throughout our presentation, different conversations, excess and surplus lines, E&S, wholesale, non-admitted. There's a lot of different, I would say, ways to phrase what E&S insurance is. So just kind of want to mention that those are all, kind of abbreviations or different ways to phrase what is, truly going to be your non-admitted, world of insurance. So, and what are these? So looking at, there are accounts that don't fit within the standard market. So that's going to be your admitted markets, your auto owners, travelers, you name it, I'm sure names that many of you are familiar with. So really what the E&S non-admitted market is in position to ensure is the more difficult classes of business. So it's something that, condominium accounts have, kind of been over the last few years kind of viewed more as a challenging risk for the insurance markets. And that can be driven by loss frequency and or severity. So, fires, water damage claims, you name it. But really, kind of either frequency being, there's been a lot of more frequent, smaller to middle-sized claims, or severity. I think we kind of call those like big pops. That's, it's going to be a large fire or something that has, maybe six-figure losses, and is something that you see on a loss run. It's kind of more of a severe loss that are less frequent. Or something else that would fall into, the E&S market that we see is going to be less favorable risk characteristics, which I know Craig kind of highlighted quite a bit of those. But, it's going to be the aluminum wiring, the stab lock, the Zinco panels. Usually when we see something that has those characteristics, it's something that usually, can fall into our space. So kind of even taking a further step back from that, I'd like to go over, really, we are saying E&S, but what is that? So it's another sector of the insurance market. So it's going to be carriers that are out there. I work with 100 carriers on, a day-to-day basis. Not all of them look at condominiums, but many of them do. And so it's a separate section of the insurance market. And these carriers have freedom of rate and form. And what that specifically means is that they are not required by the state to offer any specific coverages, use any specific forms. They really do have control over, what they're charging from a rate perspective and what coverages they're offering from a terms perspective. And in addition, as many of you are either in the E&S market or maybe have seen quotes from the E&S market, there are surplus lines, taxes, and fees that are charged as a result. In Missouri specifically, it's a 5% tax. That's going to be a percentage of the, the premium. That 5% of that will be an additional tax that, will need to be charged on every single account in the E&S space. And the reason this being is because E&S markets are not guaranteed by the state guarantee fund, which, basically is the reason that they're charging these taxes is because, if there was to be something, these markets are not guaranteed by, basically larger government and the state guarantee fund. And so this really allows our markets to be a little bit more creative with that freedom and, not being guaranteed and being part of the state government to really kind of get a little creative, craft different terms and conditions to allow them to write what are the more challenging and difficult exposures and classes of business. So we have many markets that, are going to specialize in this, but I think that was kind of alluded to earlier. So kind of going deeper into what are the benefits and the concerns with the E&S market space. So as I was alluding to earlier, one of the key benefits is going to be, creativity. That if there is a more challenging risk, let's say, there was a really large fire at, one of your properties, and the incumbent admitted carrier says, wow, okay, we just paid out all of this money on an account. We're super sorry, it's just something that we can't renew this upcoming year. Our markets will be able to say, hey, even though you did have a fire, we'll find a creative way to, either write around it with deductibles, terms, pricing to offer a solution. We always say that there's nothing that our carriers aren't able to, find a solution to insure. And that really goes into like when they're finding a solution when, there might not be one in the standard market. Our markets are able to really say, okay, we look for ways to say yes versus ways rather than ways to say no. So they're really kind of going to help craft a specific policy and program specific to, your individual risk, condominium, and exposure. And then obviously those are benefits, but, definitely want to touch on some of the concerns that, you all might have with the E&S market as well. Because there is the freedom of rate and form, and the E&S markets are genuinely looking at accounts that are a little bit more challenging. Pricing is going to be generally more expensive. Now, this is going to be either just the rate, but also the fact that there are taxes and fees that are associated with the pricing. And in addition, there is going to be coverage differences between what admitted markets are, required to provide and do provide, and what our E&S markets provide. And I would like to go into just a couple of the main ones that, generally come up. So number one being ACV on roofs over a certain age. It's going to differ from, particular carrier to particular carrier and account to account, but we generally see those ranging from, 10, 12, and 15 years, sometimes 20, if their roofs are newer than 20 years old, newer than 10 years old, et cetera, there'll be replacement costs. However, if they're older than that age, the true replacement of the roof, then it'll be ACV. So that's something that we generally see, especially in convectively exposed areas, like the Midwest, is something that we see pretty much on every policy. And in addition to that, there's also going to be cosmetic exclusions on roofs, which is basically saying, the markets are saying that they're not going to cover the repairs for cosmetic damage to the roof given from hail or wind, et cetera. And I think that, again, Craig touched on a lot of great information on, the roofs, kind of what the carrier's concerns are, kind of some of the challenges that have come through the last few years with maybe certain types of roofs not being, as to perform as expected. The life of a roof might be a little bit less than originally was thought. So these are kind of some of the reasons that our carriers have these conditions on their policies. Another item, coinsurance. So we say if there is one carrier looking at a policy and providing the full limit, let's say that the values of a condominium are, $12 million. One carrier might be able to provide the entire values on that account. And often they'll require coinsurance, which is basically their way to justify and, support and encourage that the values are being required or being provided to the true replacement cost valuation of the exposure. So they just want to ensure that, if you are providing $12 million as your total insured value, that if there were to be a loss, the true replacement cost of that value is $12 million, because that is what these carriers are rating off of. So often they'll add a coinsurance clause that will say, okay, the values need to be within 80% or 90% in the case of a loss. And if for any reason they're not, there'll be what's called a coinsurance penalty that is basically, having the, owners, the condominium association, basically say, okay, we're not going to get quite the amount that we provided, given that, we weren't reporting the true replacement cost valuation of our building. And that's what goes into, the importance of understanding and, running replacement cost estimators, having an understanding of what the true replacement cost of the buildings are. And then I just had two other quick items on, kind of the differences from coverages between, E&S and standard market that really kind of come to mind. One of them is going to be that most of our policies are going to be scheduled. Some of the larger programs, we can kind of work with the carriers to get margin clauses, potentially blanket limits. But something that I see when accounts come from the standard marketplace into the E&S space often is that, our carriers will say, we are going to go off of the schedule of values that was provided. So if you are saying that one of the buildings is $3 million, another building is $2 million, our markets will look at that and say, in the case of a loss, the most that we'll ever pay for that first building is $3 million, even though the total insured value might be $12 million. So just something to keep in mind that kind of ties in with co-insurance valuation, the importance of really understanding what the true values are when going into the E&S space, especially too if it's something that, you've been in the admitted space for quite a while. Oftentimes carriers will say, we're going to renew the policy as is. So, when and if an account does move to the E&S space, just important to really take a closer look at those values. And then, the last item that I kind of wanted to touch on, just some top of mind differences between the two are going to be just the breadth of sublimits. Usually we will see that, we have to specifically ask for ordinance and law, specifically ask for sewer backup, and debris removal, just certain items just to be mindful of that might have been included on a standard policy that aren't automatically included within our E&S carriers, initial quote. So if it's something that, is a coverage that is important to your group and something that you definitely want to look at, it's just something to be sure to be like, this is something I'm going to ask for. And, our carriers more than often than not will be willing to offer it. They might need, a certain additional premium. They'll offer different, limit options, but just something to be mindful of that those are often kind of throw-ins with the admitted policies. And because the E&S carriers have that freedom of rate and form, it's something that we need to be specifically asking for on our end with our E&S carriers. So the next topic is how do we stay out and how do we get out of E&S? So I think that, Craig hit the nail on the head with a lot of the great prevention that you can be doing in order to try to be out ahead of some of these things. My day-to-day is specific to property. So I'd like to kind of just touch on a few of those items from my point of view. Staying ahead of loss control recommendations, especially on the roofs. Roofs are going to be, especially in the Midwest, one of the first things that our carriers look at. They'll do a Google overview, look at the roof line of a property, look at the condition of the roofs, how they look on Google Maps. They'll see how close the buildings are to one another. So they really do, in addition just to our initial submission, they really do their due diligence to kind of look through and see what the condition of the buildings look like. So the roofs are a huge one, but loss control recommendations. So, if we see an account that comes across my desk that's being non-renewed by a carrier due to non-compliance with, loss control recommendations, they'll be asking for, what work has been done. But even further, more than that, just the condition of the building, making sure if there's a loss control recommendation that says, for example, there's some shrubbery that looks like it's kind of grown too close to the building, please consider trimming that back. When our markets look at images of the buildings, that's kind of just some of the control recommendations that they'll be looking for to see, how is the building taken care of. They'll definitely keep that in mind when looking at the, approach and stance to the consideration of a specific risk and, association. And then data. COPE's information is probably, I would say, one of the most important things that we ask for when looking at a submission. We'll put together a statement of values kind of based on the information that's provided to us. And we have all of these different cells that are specific to different types of COPE information. And I'll take a step back even from there. So COPE stands for construction, occupancy, protection, and exposure. So really what we're asking for is, okay, the construction type. Is this building frame? Is this building joisted masonry? Is it masonry non-combustible? So really, what is the construction of the building? What is the occupancy? So, condominium associations speak for itself, but the protections, have there been updating to the wiring? Is there Zinco panels and aluminum wiring that we should be aware of? If so, has it been remediated and how so? Has the roof been replaced? Just really, is it sprinklered? Is it partially sprinklered? If so, where are the sprinklers? We'll ask for, are there alarms, smoke detectors, fire extinguishers? Is there someone, that's walking through the property, checking on vacant units, etc.? So really, the more information that we can have on how your team is really protecting the property to make it best in class And, any additional information that we can provide to those carriers is going to be great. And then, the exposure is basically looking at, okay, is there any other additional information that we should be aware of? Is there a neighbor that, is located next to the condominium that we should be aware of? Or, is there anything else that's just really can help us best sell it to our excess and surplus lines market? And, our job as a broker is really to take all of that information that's provided and provide the best story in our submission. Our carriers get many, many, many submissions a day. So our job is in order to take all of that information and say, this is why this association is best in class. This is why this should get your attention. And this is why you should want to offer the most competitive terms possible. So, we're going to be doing that by, if there have been losses, how have you been preventing similar losses? So let's say that there was a large fire claim that, someone had fallen asleep and, left a candle burning. We'll want to ask, okay, well, then what actions have been done? Has this been addressed with the condominium? Has there been something that's been sent out? Any additional information? Or, really, if there was a water damage claim, what's been done to prevent future water damage claims similar to this? Any information that can be provided on that goes a huge way for our underwriters to say, even though there was a loss, we're going to look to try to, prevent future claims. And then what are you doing to be proactive in risk control? I mentioned that, our carriers are going to look for insureds and, associations that have a very proactive mindset when it comes to risk control. Are you going to be, are you going to be looking at those loss control recommendations, completing them in a timely manner? Are you really going to be doing everything that you can in order to ensure that, this truly is best in class? And furthermore to that, why are you better than your peer group? Condominium associations have become a more challenging class of business for many of our carriers. So what can we tell the carriers that, see these types of accounts very frequently, and to say, why is your association, better than the average condominium association? And allowing us to do that, to really tell this story to our markets, it puts, makes our job a lot easier in securing the most competitive terms. And so, I know this was kind of a footnote on the slide, but I want to make sure to reiterate that, it's not bad to think like, the E&S market isn't a bad place. It serves a really important purpose in the market and solves many problems that other insurance carriers cannot or don't want to solve. We like to say that our market's best way to describe them is creative. That they can say, okay, maybe there's been a loss, but maybe I can use the deductible to kind of underwrite around that loss. And that it really does serve a purpose in saying that, if there's not an option in the admitted or standard market, that we can find a solution with our E&S carriers. So, it really is important to better understand, why we're there. And I'm hoping that this, conversation can allow that to do that, it serves a very important purpose, and that, there is never something that there is not going to be a solution to. And it's our job to help find that solution when it's not available in the admitted marketplace. So I think that brings us to just an update on the market. So I want to be super mindful in saying that I know that, there's probably a good mix of people or associations that have been, in the standard market for years and are currently still in the standard market. There's going to be individuals, I'm sure, that are on this call that their association has been in the admitted market, but are facing a potential non-renewal and looking to see what the E&S market brings. Or there's going to be individuals on this call that are currently in the excess and surplus lines market and have seen this kind of go through, the transition from admitted to E&S, and then are kind of wondering what comes next in the E&S carrier or E&S market. So I'll start by saying that there has, been, I guess, a little bit of the, I would say light chaos of, what we had seen in the last couple of years. And that's going to be brought on by, basically losses that these insurance carriers had been seeing, whether it was the cat losses along the coast, the Texas freeze, the very very frequent convective losses. So your wind, your hail, your tornadoes. So that loss frequency had really kind of driven a change in the market over the last, probably 4 or 5 years or so. And what we're seeing now, really in 2025, is a general softening. So instead of those 20% rate increases year over year in the E&S space, we are seeing, kind of a stabilization within the E&S market. So that's going to be, I would say this year, I really am seeing 10% rate decreases on average. That's going to be given specifically to, each specific risk. So, the loss history, the loss control mindset, really what's being done. So it's not going to be every single insured, but for loss-free business that's being proactive about loss control, we are seeing a general softening within the E&S space. I will say that I'm very mindful that, that 10% rate decrease, those are accounts that are already in the E&S space. And understanding that, if you have an admitted carrier right now and are looking at, going into the E&S space, that there will still definitely be, quite a difference between the rate that you were seeing in the admitted space and the E&S space. So completely mindful of that, and just assuring that, we are very cognizant of that on my end. Our carriers are very cognizant of that. And, they will do everything they can to find a creative solution. And, we'll do everything to make sure that it is the most competitive option out there. So, because we do understand that the admitted to E&S space, those rates are very different. So, just noting that the general softening is for those accounts that are currently in the E&S space, but it's been, definitely great news for, our end, our clients, and really understanding that, the market is facing a little bit more of a stabilization. For accounts that are currently in the admitted space that are moving to E&S, some of those like continued accounts that have some challenges that we do see still coming from the admitted space to E&S and staying in E&S are going to be frame construction. That's a big one. A lot of carriers have certain guidelines around, frame, the amount of frame, the proximity to other frame buildings. So just something to keep in mind. Another one that's really huge is going to be the age of the building. Anything pre-1980, there's just fewer carriers that are able to consider it. And I do realize that a majority of the business that we see on our end is going to be pre-1980. So it just is, there's fewer carriers in the space, but, that's not to say that there aren't carriers that look at it at all. It's just that, it's something that's a little bit more challenging for our markets. And that's why, update information, if there have been updates, gut rehabs, you name it, that information is incredibly important to our carriers to allow us to go back and really, try to get the most competitive option and hopefully change some of the minds that, if there has been a gut rehab, can you consider this as post 1980? So, just something to keep in mind. Aluminum wiring, stab locks, Inco challengers, Slovenia breakers, something that we see on pretty much a daily basis. So understanding that, those are accounts that really do, if they're being non-renewed by a standard carrier, there are certain E&S carriers that consider them. And, the pricing and the rate is going to reflect those exposures. Remediation is huge. We have certain carriers that say, if you are able to get the building remediated within, 60 days, remove the stab lock breakers within 60 days of binding, we can quote at this rate, or we can consider the account when it usually would have been a declination. Another one, would be that, the type of remediation and understanding that, the unremediated aluminum wiring and the remediated aluminum wiring, there is a big difference in the number of carriers, but also, really looking at, what's the pricing going to reflect. So just something to keep in mind. And then loss frequency. So I would say that it's easier for our markets if we explain, maybe if there had been a shock loss, the severity. So saying, this was a one-off completely, wind, hail came through the area. It was a complete, happen chance. Easier for us to explain that than it usually is for loss frequency. Because at that point, the markets are going to look and say, why are these losses occurring again and again? Is there a reason that something's not being done? So just reiterating the importance that, a couple of these like smaller claims, the carriers are going to, need to figure out deductibles in order to write it. That might be higher than like the losses might have been, trying to find a way to creatively look at the account as a whole. So if there are preventative measures that can be done to prevent just that frequency of these smaller claims, it also is something that's incredibly helpful for our markets. And then convective. So, I would say that, we're seeing a lot of carriers understanding that this is like the new kind of cat peril in the marketplace. So that being that your wind, hail, your tornadoes, really kind of that just Midwestern exposure for the convective peril of wind and hail is something that is a continued challenge that markets are taking a closer look at, just due to losses that they've received on their book. So that goes across not only our E&S carriers, but also the standard marketplace. So you might be seeing an increase in wind hail deductibles, just something that we do see on a consistent basis that, is something that the market is continuing to kind of evolve and understand from. And so to know that, if you do see an increase in wind hail deductibles, it's not your own specific, your specific association. It's something that's kind of happening in the wider market. So I guess I will kind of, wrap up with that and just say that, our goal here was just to provide a little bit of additional information about, this other side of insurance, especially for those of you who might not have, had exposure or might not yet be in the E&S space, just to understand that, we're here to help, that our markets are here. This is something that we've been seeing, very consistently and really do have a great understanding. And, we'll ask for this additional information to ensure that we can create, the best possible submission to our markets to find the most competitive option and, a solution if there's not one in the standard marketplace. So we're here to help. We're, very committed to this space, this exposure and occupancy, and, all of you. So really appreciate your time. And I know that we'll open up for some questions and answers at the end. So thank you all very much.
Hi, everybody. I think I'm introducing myself. I hope that's the case. It's great to see you. I'm Dawn Bauman. I'm CAI's Chief Strategy Officer. And I am so impressed with the previous two speakers and all of the tremendous content that they've been able to share with all of you today. So important. Insurance is obviously a topic that is a part of many people's conversation, board members, managers, management companies, of course, the certified insurance risk management specialists, attorneys, et cetera. These trends that we're seeing of rising premiums, as well as the kind of withdrawal of some carriers in the marketplace or changes to policies as well, has been challenging for community associations across the US. We've seen it's not just in California, Florida. You guys know here, it's in the Heartland chapter as well. It's impacting the entire country. So I don't know if I can thank you. I don't know who's doing the slides. So the Foundation for Community Association Research, that is the research arm of Community Associations Institute. We, a couple of years ago, conducted a SNAP survey asking community associations and boards and managers what the impact was of some of these rising insurance rates and cancellations. And then we updated that survey in December of 2024. So I'm going to share with you, because I don't have a ton of time, I just brought to you today some of the key points. And the purpose of me sharing this data with you is so that you know you're not alone. While there are not solutions per se here, there are trends that can help inform you what you're hearing from your insurance professional, as well as what you're hearing from your manager's management company. So one of the questions that we asked is what the impact of different products that community associations typically carry, what the trends were on those different products. So you'll see on the left there, the products: property and casualty, directors and officers, fidelity and crime, cybersecurity, flood, wind, wildfire, hurricane, and earthquake. And then you'll see this is a national survey. So you'll see how many of these people, and there were nearly 1,000 respondents to this survey, representing multiple thousand community associations. So you'll see which products are not carried. And then you'll see in the middle column, the policies that were either canceled or not renewed. Now, while the percentages are relatively low, if a community association does not have property and casualty insurance, so 23% of those that responded to this, their policy was canceled. Now, hopefully they were able to get it somewhere else or from a state-funded plan. But what that means is, first of all, it's a lot of community associations that had a cancellation. What that means is the increase was likely pretty significant, or the coverage that they now have is likely not adequate for what they need as an organization, or what is required of their community to have to fulfill their fiduciary duty that is required in the bylaws, or even to fulfill the requirements that are looked at by mortgage lenders for lending in that community. So again, while that's a small number, 23%, it is actually has a very big impact. The same with directors and officers insurance. That's a really high number, 14% to be either non-renewed or canceled. Now look over at the next column, the increase in premium in 2024. Again, we captured this data at the end of 2024 in December. So all of these products have seen an increase, and a huge increase in the most common products carried by community association, 89% for property and casualty, 86% increase for directors and officers, fidelity and crime 84%, and you see the others as well. Now, what's important about this is these increases obviously have an impact on community associations and their financial stability of the community association. So we're going to talk about that next. So one of the questions we asked is, did the premium increase? I just shared with you the if the premium increased on the variety of the property and casualty. So 93% said there was a premium increase. 6% said no. I've been having conversations, and I'd love to hear from some of the insurance professionals on the call. I've been having conversations with insurance professionals throughout the country. And what I'm hearing right now is that the premium increases, that the insurance professionals are not seeing the increase now that has been seen over the last couple of years, that things are stabilizing a bit. And that's what stabilizing means. It doesn't mean things are going back to where they were a couple of years ago. They're just not increasing at the same incredible rate that we saw over the last couple of years. So maybe those insurance professionals can put in the chat whether that's anecdotal information, whether that's what you're experiencing or not. So as you'll see, one of the other questions we asked is, if your community experienced an increase in premium for property and casualty only, how much was that increase? So I love that, Karen. Can you just be you can just come with me wherever I go, so you can always say that. So under $5,000, 24%, $5,000 to $10,000, almost 20%, $11,000 to $20,000, 18%, $21,000 to $50,000, 14%. Now, of course, we're seeing like more than $100,000, 12%. That's a big number on both sides. And when we're talking about that type of increase, obviously we're talking about premiums that were higher in the first place and are increasing tremendously. The higher dollar increases we're seeing are typically with bigger condominium projects. That's where we're seeing some of those increases. So I'll share with you as well So we asked the question, if your community experienced an increase, how was it funded? So operating funds is the most, increase in regular assessments. So operating funds, 50%. Increase in regular assessments, 71%. Now, again, that's a big number, increase in their assessments just for insurance premiums. Now, this data can be very helpful and very valuable for anybody meeting with boards of directors and owners that are looking at discussing an increase in regular assessments. My guess is, and this is what I hear anecdotally around the country, is that community associations are increasing assessments for a variety of reasons. It's typically rising costs and an increased emphasis on maintenance or funding reserves. So this is like the perfect scenario where there's a demand right now. Everybody who's anybody knows you need to have funded reserves. And there are state laws, states changing laws to require reserve studies and reserve funding. Everybody now knows maintenance is critically important. If you do preventative maintenance and regular maintenance, your maintenance costs are going to be approximately 30% lower than if you were to defer maintenance. Deferred maintenance costs on average 30% more to the association. So spending money on regular maintenance and not deferring the maintenance, spending money on funding reserves, spending money on an increase in premium for your insurance, all results in the need to increase regular assessments. Now, so having some of this data can be really valuable when boards and managers and insurance professionals are talking with homeowners in these specific communities to help explain what these assessments are going to pay and why the increase, and to demonstrate that your community is not alone. There are so many other communities that are faced with these same circumstances, and having this data can be helpful. 31%, I'm sorry, can you go back? 31% has said they've had to engage a special assessment just to pay for the insurance premium, or a line of credit, 6%, just to pay for the insurance premiums. Some have been able to use reserve funds, of course. I don't want to freak any of the lawyers out on the call, but of course you need to look at your documents and make sure that you can use your reserve funds for something like that, and that you use the proper process that's in place. So this is super important. Can you imagine taking a bank loan to pay for your car insurance, or to pay for your house insurance, for your single family homeowner's insurance? 6% of those who responded to the survey have had to do that. And that's something that's important. That's why the people that you've heard, the professionals that you heard from just before me, talking about mitigation efforts can be really valuable. I think are going to help over time bring some of these costs down. Okay, now I'm ready for the next slide. Thanks. One of the questions was, for the property and casualty insurance at your last renewal, were high deductibles or per unit deductibles forced or requested by the insurer? That's something that is a valuable proposition in some cases, to increase the deductible so that the premium is lower. So you'll see about 30% did have a requirement that the deductible be increased in order to manage the policy. Now, of course, the problem there is, if we're talking about a condominium or a housing co-op, it is possible then that the deductible will not comply with Fannie Mae and Freddie Mac lending requirements. So if the deductible is too high, then that condo or housing co-op might not be, that building might not be eligible for lending products from Fannie and Freddie, and Fannie Mae and Freddie Mac provide mortgage products for about 70% of the mortgages in the US. So not having access to those, you're going to see in those buildings an increased cost or limited access to mortgages. So people will have an issue or challenge selling or buying in that building. And then for the property and casualty coverage, does the coverage have at least 100% of the replacement value of all the property owned by the association? So nearly 80% is yes. Oftentimes, this is a requirement for a Fannie Freddie loan, thinking of those condominium and housing co-op buildings. Also, oftentimes, it is a requirement of your documents. So this is important that compliance with the documents be consistent. And I'll say, you know, Kathy Roth Johnson always does an amazing job pulling these together and giving you the experts to give you advice on these topics. If your community, or if you all use an insurance professional who is not a certified insurance risk management specialist, is not experienced in condominium, co-op, HOA, policy coverage, they're not going to think about the implications of the documents, of the Fannie Mae and Freddie Mac lending requirements. They're not going to have that information. So they may be writing policies that are not consistent with what you need in your building to be able to keep it a highly functional building and a marketable building as well. So another question is regarding the HO6 policies, especially, again, these are in buildings, condos, HOAs, townhomes. Do your documents require individual homeowners to carry an HO6 policy? So about just over 50% say yes, 25% it was not applicable. I'm imagining that must be maybe homeowners associations where it's not a requirement, single family homes. 18% said no. Now we are, okay, I get you guys are going to address these questions afterwards, and maybe even as we go. But HO6 policies can be very valuable. That requirement can be very valuable for condominiums, and I think is something that Fannie Mae and Freddie Mac may bring back to the conversation as a requirement as they try to navigate maybe changing some of their other insurance requirements. I'm going to talk more about that in just a second. So the next question, if your community did have an increase in property and casual premium, how much money per homeowner did it cost? And this is per year. So under $100. The good news is 34% said it was under $100 per homeowner per year. And another 31% said it was about $100 to $500 per homeowner per year. And of course, we all know the homeowners are paying for it, right? Unless there's a money tree that somebody has planted in their community. And if so, if you could just send me a little piece of it that I can plant on my own with my avocados and garlic, that'd be amazing. And then there's 8%, the increase was between $500 and $1,000, 4% $1,000 to $2,000, and 4% more than $2,000. Again, that's per homeowner per year. This is valuable information that you'll be able to share with your homeowners as you're talking through some of these increases as well. Some of the comment trends, I don't know if you can see this or not. I'm just going to, these were just some of the overwhelming trending comments that we heard in this survey, which was premium increases, obviously, which resulted in sometimes a lack of sufficient coverage for the community. Concerns over affordability, same thing. Non-renewal and market withdrawal. We hear a lot of this, of the community associations getting a notice of non-renewal and then having these insurance providers pulling out of the market altogether. Now we're hearing more of that in the coastal area. So we're hearing more of that in Florida, California than we are in other states, but it is still happening in other states. That high deductible and coverage limitations. So this is something that's also been trending, which is wind, hail, water, flood, that those coverages in some areas are just not available. Well, two problems with that. One, oftentimes the documents say you must have that coverage. Two, in order to, especially for condominiums and housing cooperatives, to comply with Fannie Mae and Freddie Mac guidelines, you need those pieces of coverage. So I know there's been some creativity in some of these professional insurance experts pulling together different products to kind of bridge the gap. Sometimes that's possible, sometimes that's not possible, but noticing that those coverage limitations do exist. Availability and choice of carriers, we're seeing again a withdrawal in the marketplace. And then some frustration just with claim payouts and insurance practices, more about claim payouts, insurance payouts, that some things are just not covered, and there's some frustration around that. And I think that's probably more of an education process than than circumstantial. So that's why it's so critically important for those of you managers, management companies, boards, invite your insurance professional to your board meetings on a regular basis. Let them share with you what's covered in your insurance policy. Ask them to go through they should do a presentation to the boards on an annual basis so that the boards know what products they have and they can ask questions. It's so important. And they're willing to do it, especially if they are industry professionals. So I did mention a couple of times that there are issues specific to Fannie Mae and Freddie Mac and their lending requirements for condominiums and housing co-ops that are creating problems where the condominium association or housing co-op is being put on an ineligible list, which means it's a list that Fannie and Freddie are separate. They're two separate government-sponsored enterprises that buy loans from mortgage bankers, mortgage banking companies. They buy loans and they buy loans, take the loan, give the mortgage banker the money so that mortgage bankers can keep lending money. And the Fannie and Freddie owns these loans. Now, they want to make sure that the people are going to pay these loans back. So they create criteria that these loans must meet before they're willing to buy them. So the criteria that they created for condominiums, following the condo collapse in Surfside, Miami, Florida in 2020, it's coming up on the 5-year anniversary in June. Following that condo collapse, Fannie Mae and Freddie Mac made a bunch of changes to their lending requirements that define which loans they're willing to buy from mortgage lenders. And some of the requirements that they made have caused a problem for condominiums and housing co-ops especially. And some of the core problems that we're working with Fannie Mae and Freddie Mac on to try to make changes to include the following. Someone just put this in the chat as well. It's the shift from the actual cash value for replacement of roofs, shifts from actual cash value to actual replacement value to actual cash value. So actual replacement value treats it like you get a brand new roof. Actual cash value treats it like the insurance is going to cover the cash value, which is based on depreciation. So that's a big difference in coverage, and Fannie Mae and Freddie Mac require right now actual replacement value for roofs. Well, that's like asking somebody who has a 1980 Ford to make sure that they have insurance so that they can get a 2025 Ford and get that car paid for if they ever had a problem with their 1980 Ford. Just doesn't make sense. So we're trying to get them to make that change because it's both expensive and sometimes not even available. The other is to eliminate the 100% replacement cost requirement for buildings. Now, while it's a good idea to have 100% replacement cost for a building, sometimes it's impractical and the insurance is just not available. So if it's not available or it's exorbitantly expensive, it just doesn't make sense for that community association to have that product. And remember, it's an annual premium. So to just eliminate that requirement. And again, the reason that Fannie Mae and Freddie Mac changed their requirements and tightened their requirements on condo buildings is so that they lowered their risk of having mortgages that defaulted. So they've created a higher level of expectancy, not based on the danger of having a building that's not going to, where they will be a default in that building. I would argue with the insurance premium problem that's throughout the country, that creates more of a potential in individual homeowners defaulting on their mortgage than having the building not be safe and having all of the individuals default on their mortgage. So the third issue that we're working with Fannie Mae and Freddie Mac on is to eliminate the 5% deductible per owner cap and replace it with an HO6 policy requirement. So right now the requirement says that the association can have no more than 5% deductible per owner for their property and casualty insurance. Again, the problem with that is it creates it's a much higher premium that's less affordable for most of these condominium associations. Finally, and this is not insurance related, but I wanted to share it because it's important. Fannie Mae and Freddie Mac have a reserve study and funding requirement. And they want to make sure that associations have adequate reserves or have a budget of 10% for reserves. Well, we all believe it's a good idea to have adequate reserves, but we also believe that it's not practical for all associations right now, immediately, to have fully funded reserves. So we want to make sure that Fannie and Freddie don't reject a building or put them on an ineligible list because they don't have fully funded reserves. They should have an opportunity, they being the condo associations and housing co-ops, should have an opportunity to develop those reserves and build those reserves over a practical period of time, 3, 4, 5 years, something like that. Those are the topics that I wanted to share with you today. Please stay in touch and happy to answer any questions that you all may have.
Thanks, Craig, Manny, and Don. We appreciate you guys. We're going to open it up for questions. I think we have a couple that happened in the chat, but you can also post them in the Q&A. If you have questions, Karen or Jessica, have you seen any come through? I know that there was a couple in the start of the chat. Let me look and see.
Yes.
Yep, we had a couple for Craig at the beginning.
So, Craig, this is for you. It said, what would Billy recommend on the solutions? And I think this was either when you were talking about asbestos or the lead paint, but what would Billy recommend on the solutions? How effective is encapsulation? this person assumes removal is preferred. So it's kind of your opinion about encapsulation versus removal.
Sounds great. Yeah, well, with regards to asbestos, it depends really on where it's located within the building, and as well as, you know, the condition of that asbestos. If you're talking dealing more with the pipe wraps, you know, a lot of times if like corners will typically get bumped and things like that, that's where you'll have issues. Encapsulation, you know, is fine. Removal is best. I mean, that's going to be, I mean, period. If you can do the removal, you want to do that. Acceptable would be encapsulation. Unless you start seeing a lot of it, then you would want to go ahead and get it removed. Again, if you have a fire or something like that in the building and you have asbestos, that cost for getting that building replaced goes up dramatically, because now before they can do anything, they gotta, you know, basically tent the whole building and remove the asbestos and then get to it. So removal is the best. Encapsulation, as long as it's not in too bad a condition, would be acceptable. Paint, lead paint, things like that. Encapsulation, again, encapsulation works fine for lead paint, as long as you have, you know, good encapsulation over the top of it.
Okay. Another one came in for you, Craig, about the time you were talking about proper collection of certificates for vendors and that type of thing. And this question is, how about vendors of homeowners that work in their units? Should they submit a certificate of insurance to the HOA?
I do recommend that, just from a standpoint, if you have, if again, they're connected units, and it really depends too, if we're talking, you know, stackable units, or if we're talking, if, you know, just individual home, you know, that are duplex, things like that, you know, they're not going to affect quite as many people. But if something happens to your property, it's more than likely going to affect your neighbor. It's going to affect, you know, so as a homeowner association, you want to make sure that they're bringing in reputable contractors to be doing work. So you can set up, you know, a listing of preferred contractors, you know, and you can give them a couple, you know, and do a couple different ones on there, to where you've gotten that information, to where you know what they're that they, you do have their certificates of insurance, you got their, you know, you have some identification language for your you know, condo association, to where that sets everyone up for success in the event of, you know, something that goes awry from what the work that's been done. But it also helps ensure that you're bringing in a reputable contractor.
Thank you. We have another one that came in from Gloria. I don't know who this would go to, Dawn, Jim, or myself. If a declaration says balconies are limited common elements and the responsibility of the association, and also says the balconies are to be maintained by the owner in a manner satisfactory to the board, does the owner or the board insure the balcony? That's part one. And then part two is who is liable. And I can take it, Jim, you can chime in. Who insures the balcony when it's a limited common element? Well, first of all, let's explain that if it's a limited common element, that means it's a common element. Limited is just a subset of a common. So typically all common elements are insured by the association, and maintenance does not. It's a whole separate section than insurance. Who is liable? We're going to let some attorneys answer, but I'd say everybody. Jim, you want to take that?
When there's a deck
Dawn.
collapse, everyone gets sued, and everyone usually loses. And they're going to go after the deeper pockets, which tends to be the association, who's going to have higher liability limits. And we've had a few deck collapse claims where the governing documents did state the unit owner was responsible for maintenance, yet, you know, governing documents usually have enough gray areas where a creative plaintiff's attorney will find a way to collect from whoever they can collect from. So, you know, I'm while a lot of governing documents put the responsibility to maintain on the owners, it's not always practical. And again, I think Karen's right. You need to speak with your attorney. But as far as insurance goes, it's usually the going to be under the association's master policy.
Kathy, that's all the questions I see.
Okay, just wanted to thank our presenters and our sponsors, Karen and Jessica from our program committee for helping coordinate this and organizing this. Just a couple of events I want to shout out. So our next in-person program in St. Louis is May 14th. We're doing it a little bit later in the month because we have CEI conference a week before. It's going to be our maintenance roundtable, water, the silent killer of budgets. So it should be a good one. We have 4 presenters talking at that one. We also, our next webinar will be June the 4th from 11 to 1, igniting your passion, finding your purpose. So make sure you get all those on your calendar, and we hope to see you at events coming soon. I'm going to share the link to our events page in the chat. We hope to see you guys next time. Thanks, everybody. Have a great rest of your week and be safe out there in the storms.
Bye, everyone. Thank you. Good to see you.
Bye. Thank you.